Hey guys, welcome back. So are you a self-employed business owner and wondering about the approval process for refinancing or trying to purchase a home during this time? Well, that's what we're going to dive into today. We're going to look at Fannie Mae's latest lender letter that came out yesterday that goes over the guidelines for self-employed business owners and how Fannie Mae and Fannie Mae will look at income with regards to those who are self-employed. We'll also touch on those who have actually filed for forbearance during this time and how they're going to look at that. But before we get into it, my name is Jeb Smith. I'm a real estate broker here in Southern California. If you're new to my channel, it's all about real estate, whether it's buying a house, selling a house, mortgage finance, or trending topics like forbearance. So do me a favor, if you like that information, want to keep up to date with what's going on, become more educated, do me a favor and hit that subscribe button there. And if you like the content, give me a thumbs up as it helps more people see it. So we are going to dive into the actual lender letter that came out yesterday from Fannie Mae. I'm going to bring it up here on the screen in a minute and I'm going to read it verbatim just so you get it straight from the horse's mouth, if you will, with how the income qualifications are going to work with self-employed business owners, what they're going to look for, and also how they're going to look at those of you who have filed for forbearance who are self-employed as well. How are they going to take that into account with regards to refinancing or buying a home in the future? So let's take a look at it here. I'll link to it below as well in the description in case you want to pull it up for yourself and do your own. Okay, here we are. So again, this is the Fannie Mae letter, lender letter that came out yesterday, which was the 28th. Here we are with the requirements for borrowers using self-employment income to qualify. Effective, lenders are encouraged to apply these requirements to existing loans in process. However, they must be applied to loans with application dates on or after June 11th. So if you're currently in the process, they're telling them, hey, use these guidelines, but definitely after the 11th, you need to stick to these guidelines. So income analysis, how is income going to be looked at during this time? Self-employment income is variable in nature and generally subject to changing market and economic conditions. Whether a business is impacted by an adverse event such as COVID-19 and the extent to which businesses' earnings are impacted can depend on the nature of the business or the demand of the products or services offered by the business. Income from a business that has been negatively impacted by changing conditions is not necessarily ineligible for use in qualifying the borrower. However, the lender is required to determine if the borrower's income is stable and has reasonable expectation of continuance. So basically, as a real estate agent, right, my business has been affected by COVID-19. Essentially, they have to then verify, because my business has been affected, if my income is stable and does it have a reasonable expectation of continuance based on that stabilization. So that would be an example for you. Due to the pandemic's continuing impact on businesses throughout the country, lenders are now required to obtain the additional documentation to support the decision that the self-employment income meets our requirements. An audited year-to-date profit and loss statement reporting business revenue, expenses, net income, and including the most recent month preceding loan application date. So an audited year-to-date, which basically means it would have to probably be done by an accountant. You're going to need your CPA to verify that that information is correct. They're also going to want an unaudited year-to-date profit and loss statement signed by the borrower reporting business revenue, expenses, and net income up to and including the most recent month preceding the loan application date, and 2 business depository account statements no older than the latest 2 months represented on the year-to-date profit and loss. So business depository accounts, so bank statements, they're going to want to see deposits going in for the preceding last 2 months. And they're going to match it with the profit and loss statement, it looks like. Go on down a little bit more. The lender must review the 2 most recent depository account statements to support and or not conflict with the information presented in the year-to-date current profit and loss statement. Otherwise, the lender must obtain additional statements or other documentation to support the information from the year-to-date profit and loss statement. So basically what they want to see is a profit and loss statement and bank statements that verify what your profit and loss statement says. They go down here to talk about different business operations, income, etc. Let's see here. But let's go to see how they're actually going to calculate income. When the lender determines current year net business income has been impacted by the COVID-19 pandemic and is less than the historical monthly income calculated using Form 1084 but is stable at its current level, the lender must reduce the amount of qualifying income calculated using Form 1084 to no more than the current level of stable income. So basically, if you're making less income than you have historically made, they're going to use the current level of income versus what you've, your average over the last, say, 2 years based on your tax returns. They go on to say more than the historical income calculated using Form 1084, the lender must use no more than the currently stable level of income calculated to qualify the borrower. In all cases, qualifying income must be supported by documentation, including any supplemental documentation obtained by the lender. So they're going to ask for additional information. Business assets. We are clarifying that proceeds from the SBA, PPP, or any other COVID-related loans or grants are not considered business assets. So you can't use those assets that you receive from the SBA as part of your business income assets. Temporary eligibility requirements for purchase and refi transactions. Here we go. So lenders may immediately apply these policies to loans in process and must apply them to loans with application dates on or after June 2nd. These policies will be effective until further notice. All right, so lenders must continue to review the borrower's credit report to determine the status of all mortgage loans. So they're going to stay up to date on mortgage loans to make sure you're paying. In addition to reviewing the credit report, the lender must also apply due diligence to each mortgage loan on which the borrower is obligated, including co-signed mortgage loans and mortgage loans not related to the subject transaction. So they're going to look at all your loans, even if you're a co-signer on a loan of somebody else. They want to make sure that person is making the payment and it's not going to affect you. For the purposes of these requirements, current means the borrower has made all mortgage payments due in the month prior to the note date of the new loan transaction by no later than the last business day of the month. Examples of acceptable additional due diligence methods to document the loan file include a loan payment history from the servicer or third-party verification service, a payoff statement for mortgages being refinanced, the latest mortgage account statement from the borrower, and a verification of mortgage. A borrower who is not current and has missed payments on any mortgage loan is eligible for a new mortgage loan if those missed payments were resolved in accordance with the requirements in the table below. Reinstatement. We've talked about this in other videos. If the borrower resolved missed payments through a reinstatement, they are eligible for a new mortgage loan. The lender must document the source of funds in accordance with eligible source of funds in the selling guide. So basically, if you paid off your mortgage to reinstate it, you've got to show where those funds came from that you paid it off with. If the reinstatement was completed after the application date of the new transaction, proceeds from a refinance may not be used to reinstate any mortgage loan. So you can't pull cash out to, reinstate a loan. Loss mitigation solution. If outstanding payments will be or have been resolved through a loss mitigation solution, the borrower is eligible for a new mortgage loan if they have made 3 timely payments as of the note date of the new transaction as follows. Basically, they talk about payment plan, the deferral, a modification. We've talked about this in other videos. They are going to say your loan is reinstated once you've agreed on a repayment plan. So that is really good news. Those payments don't have to all be made. There can be a payment plan made, at which point you can, your loan's considered reinstated, and you can start the 3 months of consecutive payments, at which point you can purchase a refinance. Now, verification that the borrower has made the 3 required timely month payments may include a loan payment history from the servicer, the latest mortgage account statement from the borrower, or a verification of mortgage. It goes on to say, we are not considering payments missed during the time of COVID-19 related forbearance that have been resolved to be historical delinquencies for purposes of excessive mortgage delinquency policy. So they're not looking at things that have happened with your mortgage during COVID as a negative with regards to the refinance and purchase side, as long as you can, you've made the 3 timely payments, you've paid you've reset your payment plan, whether it's, you've paid a lump sum,
the repayment plan, the loss mitigation, or the deferral, as long as your loan has been reinstated, then they're not looking negatively upon you with regards to refinancing and purchasing. So I hope that information is helpful. I went over it very quickly to keep the video short and not bog it down. But if you want clarification on this stuff, let me know.
All right, guys, there you see it. So there's a lot of information that I just threw at you with regards to being self-employed, being a business owner, and buying a house during this time. But more or less what it boils down to is, it's not a case-by-case basis, but the lender is going to look for specific things in there, and two people side by side might not be compared exactly the same, right? They want to see some consistency in the business income. Like I mentioned, it doesn't have to be that you're exactly where you were at this point last year, but they will take that income and qualify you based on where you are going forward. So again, I hope that was helpful. If you do have additional questions about this, though, do me a favor, comment below, reach out to me directly. I'm happy to address what I can, and where I can't fill in those blanks, I'll definitely put you in touch with someone who can. But as always, I appreciate you taking the time to watch. I appreciate your support, and we'll see you again soon. Have an awesome day. Bye-bye.